So maybe we just begin, right? So we're right on 12. So we're very happy to have Aprajit Mahajan from UC Berkeley, who's going to talk about financial access in Mexico, right? So,
Hi. Yeah, so thanks very much for inviting me. And it's very nice to be able to give a talk at ISI. And I guess it's much easier in some sense, although it'd be much better in person, of course. Um, so Hello. Hi, I think I was muted.
yeah,
Kanish, should I unmute myself? Should I go ahead?
yeah, you're fine. You're fine. Sorry.
Okay, all right. So this is joint work with Sara Castellanos from the Central Bank of Mexico, Diego Hernandez, who was on the market this year and I think just accepted a job at the Chicago Fed, Enrique Serra, who was a graduate student at Stanford and is now teaching at ETAM. And so I guess in terms of, so please feel free to interrupt me anytime. And in terms of kind of broad overview of this paper, so this is a paper we've been working on for a while. We have sent it to a couple of journals. We've gotten kind of a lot of mixed reviews. And so it'd be very helpful to get kind of feedback, partly in terms of how we should think about framing the paper, because essentially some of the feedback we got was that it wasn't really clear how to frame the paper. So I think that's one particular issue. And then the other issue I think is, as you'll see, is that some of the evidence is much less convincing than the other evidence. And so then the question is, do we play up that evidence, or do we just sort of leave it out of the paper altogether? So our view right now is that it all hangs together as a paper, but it'd be nice to have opinions on whether maybe a shorter version is better. So in terms of big motivation, I think the motivation for us, originally came from thinking about the fact that even though there's been sort of a lot of work on financial inclusion or certain aspects of financial inclusion, in particular microfinance, which is sort of maybe going over 20 years or so in terms of work around microfinance. So we understand some aspects of credit being offered to households or populations without access to formal credit. On the other hand, much less is known about the financial inclusion efforts or the efforts to reach underserved populations by large financial institutions, by which I basically mean private banks, whose scale is potentially, you might think might be important for expanding access. And I'll talk a little bit when I get to the literature section about an earlier literature that kind of did some of this. But for, what I mean in particular is, so for example, in 2009, Mexico together had about 2.3 million clients if you aggregate across all the microfinance institutions in Mexico. On the other hand, the single largest sort of financial inclusion product, the one that we study in this paper, alone had about 1.3 million 1.3 million clients at that time. And so that's sort of what we mean by these large financial institutions potentially may have the scale for reaching these underserved populations. And more generally, if you look at the credit bureau in Mexico, you see that in fact non-MFI banks have a much larger share of first-time formal loans relative to MFIs. Although this needs to be qualified a little bit because not all MFIs in Mexico report to the credit bureau, although some certainly do. So in particular, we are thinking in this paper of sort of credit card lending as a means of financial inclusion. And this is something that's become increasingly common in the past maybe 20 years or so for banks and financial institutions to reach out to sort of newer borrowers. So for example, in Mexico, 74% of all first-time formal loans, so when you sort of enter the formal credit sector or the credit bureau, you enter it through a credit card of some type. And that comparable figure is about 83% for Peru, about 51% for Colombia. So we were trying to actually collect numbers globally for this. We've only been able to find them for 4 or 5 countries. Even in the United States, actually, 50% of all first entries in the credit bureau are credit card entries. So this expansion hasn't gone unnoticed. So there's been a considerable amount of sort of policy and regulatory attention paid to this kind of expansion. And there have been sort of a fairly varied set of responses as well. So, they range typically from trying to regulate contract terms in some form. So, for example, in Mexico, and Taiwan, there are floors on the minimum payments that people must pay on their outstanding debt each month. In the United States, there's work that mandates kind of transparency in the contract terms of the credit card bills. So you have to be very transparent about those terms. In South Korea, for example, there are limits on interest rates, and there are also limits on the kind of penalties and the fees that you can charge. So despite this kind of increased attention from policymakers and these kind of policies that have been instituted, there's actually comparatively little academic work about what the characteristics of these new borrowers are, and what the potential effects of these proposed regulations might be. And so that's sort of where we'd like to make a contribution. What we want to do is tell you a little bit about both of these, both sort of the effects of potential regulations, as well as kind of what kinds of characteristics do borrowers have who come in through these credit cards. And so the idea is to use data from Mexico, both observational and experimental data. The observational data is really detailed credit bureau information from one of the two major Mexican credit bureaus, and then we'll combine that with experimental data run by one of Mexico's largest banks, which is kind of a large nationwide randomized control trial, which will hopefully tell us something about the effect of changing contract terms on borrower and potentially bank welfare as well. So that's sort of what we'd like to do. And I guess I should mention at the outset that this was not an experiment that we ran. This was, in fact, an experiment that was run by the bank internally. And there's a little bit of a story behind why the experiment was run, which I think also is maybe relevant for motivation, which is that the Central Bank of Mexico became concerned in the mid 2000s about what they called kind of over indebtedness by new borrowers. And they were worried that these banks were expanding too quickly into these underserved populations, making borrowers take on too much debt was sort of the argument, and therefore leading to higher rates of default and sort of potentially introducing instability into the financial system. And it was in part to address these kind of concerns that the bank that we got data from actually ran this experiment. So I think that's also useful as a way of motivation for thinking about why this kind of experiment was needed. I'm just realizing I can't see people's hands or anything. Kanishk, is there a way for me to? So maybe you should just interrupt me, because I don't think I see hands on my Zoom.
Yeah, I want to. Aprajit, can you hear me?
Yeah, I can hear you.
Yeah, Abhirup here. So I was just wondering. So this RCT, but the purported aim of this RCT is essentially to increase the welfare of the banking system, right? The borrower impact is in some sense the implied impact of whatever the banks do, with that as the main criteria. Would that be fair to say?
So I think that it's a little bit hard to tell exactly. The sense that we got from talking, and of course there's a lot of employee turnover in the bank as well, but the sense that we got from talking to the bank employee who was sort of most closely involved in the RCT, it was sort of the central bank worrying about this bank charging interest rates that were too high and minimum payments that were too low. And that was leading to sort of excess default in some sense. And so, limiting that default was something the central bank thought that the bank could do. And I guess they viewed that as beneficial to both borrowers and the banking system as a whole. That's just the policy perspective. And, I guess there's a big literature in econ about, what we even mean by things like over indebtedness and so forth. I don't know if that answers your question. So I'd say from the central bank's perspective, it was a bit of both. The bank's own perspective, one thing I should add is that this bank runs experiments like this all the time. And this is true, I think, for credit card companies in the US as well. Not quite so large, but they do run these kind of experiments. So it wasn't unusual for them to run this experiment.
I see. And just maybe you'll come to it later, so you can answer the question later. But I was wondering whether so on what basis were power calculations made for these RCTs?
That's
Or was there one? I mean,
so that's a good question. We haven't actually been able to talk to the person who designed the RCT. That person had left the bank by the time we got data, and so we don't actually know what the power calculations were, if any, and what they were optimized for. As you'll see, the sample size is actually very large. And in fact, this is one of the situations where we have where we don't mind the new policy of not removing stars from the tables, because all of our coefficients, when they're significant, are significant at like the 0.001 level or something.
I wasn't worried about. Actually, I wasn't worried about the power and that power question. I was trying to figure out, maybe one can figure out what they were aiming to do from essentially the design, right? I mean,
I see.
If I'm trying to target some particular indicator, but that's.
Yeah, so that's so as you'll see in the experiment, it was fairly well done in the sense that they ran a stratified RCT, and they stratified their client base into 9 potential strata, into 9 potential strata, and so I don't know if they were optimizing for a particular outcome, but they definitely oversampled from strata that had relatively few clients in them. And so one of the things that we are going to end up doing is having to reweight the sample, because they picked an equal number of units, even from strata that were actually fairly small in the population. So in that sense, I think they were interested in looking at all the strata. But of course, if you want to be representative, then you want to do some kind of weighting.
Right. Thank you.
All right. Okay. So just to give you a basic sense of what I wanted to show you today, essentially, I'll try to show you sort of two things. So the first is I will try and tell you something about the characteristics of these new to credit borrowers, what my co-authors prefer to call new to banking borrowers, so NTB, and this is an acronym that has stuck, even though I personally don't like it that much, but I'm going to use it for that talk. And then I'm going to talk a little bit about the RCT, and then I'll have some very speculative evidence about some of the things that we can't really answer with the first two. So in terms of what the characteristics are, so as best as we can tell, these new to banking borrowers seem to be credit constrained. So we have sort of we use an off-the-shelf measure of credit constraints, and at least by that off-the-shelf measure, these borrowers about thrice as credit constraints relative to this measure when it was computed for the US. So it certainly seems to be that this is a population that demands credit. We'll also show you that, again, this is all observational. We'll show you about 1/5 of all borrowers default over the 2-year study period over which we have most of our data. And this default rate is much higher for borrowers with limited tenure with the bank, so much higher for newer borrowers. So borrowers default at higher rates. At the same time, borrowers also exit for other reasons. So about 13% of all borrowers voluntarily cancel their credit card and leave. Many of them, in fact, switch banks. And this actually, I think, is the part of the paper that, if we had something convincing, would probably be the sort of thing that would make it attractive to referees. And as you'll see, our evidence here isn't super convincing, but I think that's sort of the part where I think if someone can do like a nice paper there, I think that would publish super well. And then given the fact that we have a lot of information on purchases and payments and fees from the bank, we're also actually able to construct a measure of bank revenue per card. And admittedly, it's fairly noisy, but we do think there is some signal in it. And to the extent that you believe it, there's a huge amount of variation in this revenue that the bank gets from its borrowers. And that this revenue, in fact, is also hard to predict ex ante. So we use kind of a range of, machine learning methods and a range of observables, and show that basically it's fairly hard to predict, either revenue or default for this population. So in part, this is not so surprising, because you think these are new to banking borrowers. They don't actually have a lot of data to begin with. And so the prediction problem is sort of difficult for them anyway. And so then I guess in a natural sense, you might ask, well, if screening is difficult, it may be actually useful to then think about whether kind of manipulating contract terms after people get these credit cards is going to do anything in terms of reducing default. And so what we're going to do is to use an RCT to answer this question. So we're going to work with a study credit card, a credit card that I'm going to call the study credit card, that accounted for 15% of all first-time formal sector loans in Mexico in 2010. So this was kind of a flagship financial inclusion product issued by the bank, and we'll talk a little bit about what lending to new to banking borrowers looked like in Mexico in the mid-late 2000s, and this was sort of part of that expansion. And what we find is, in fact, in some sense disappointing, in the sense that we find that even pretty substantial reductions in interest rates and even pretty substantial increases in minimum payments have pretty small effects on default. So the elasticities we find for interest rate are about 0.2, and these are pretty small compared to the other elasticities that people have found also using RCTs elsewhere in South Africa and Mexico. The elasticity that we find for default with respect to minimum payments is a little hard to benchmark, because there actually haven't been very many papers that have looked at minimum payment, and there haven't been any experimental papers. But our sort of general sense is that these numbers are pretty small even for minimum payments. We're going to I'll talk a little bit about the policy implications of that as well later on. We find perhaps even more disappointingly that these responses are smallest for the people who you might worry about the most, which is like the newest borrowers, so the people who've been with the bank for the shortest amount of time, are in fact the least responsive to these interest rate and minimum payment variations. And then we also show that in fact these changes in minimum payments and these changes in interest rate also decrease bank revenues. So there doesn't seem to be any clear winner here, in the sense that these, for example, increasing the minimum payments doesn't change default, increases, as I'll show you, cancellations, and overall decreases bank revenues. So you can think about Mexico and Taiwan and places like that have instituted these higher minimum payment regulations with a view towards limiting default, and at least the RCT here suggests that minimum payments by themselves in the short run don't do very much to limit default, although as you'll see, we have some evidence that suggests that there might be two effects that are counteracting each other with respect to minimum payments. And so we'll try and untangle a little bit. We'll try and angle the zero of the minimum payment a little bit towards the end of the paper. And kind of stepping back, yeah, go ahead.
Rajat, so can you to some extent describe the situation in 2010 in Mexico, given that it was post the financial crisis? I'm just wondering, whether the way banks behave or the way customers perceive banks behave it was kind of atypical, or was it business as usual going on? Because there was, right before that, there was a lot of turmoil in the financial markets and the banking sector. So I'm not talking about in some sense generalizability within that year. That's fine, but I'm just thinking about whether the population at that time was going through something which is slightly different, which would account for some part of what you find.
Yeah, so I think there is definitely an element to that. So one of the things you'll see is in the paper, we spend more time on it, is that in fact, starting around 2000, I would say maybe late 2008, 2009, we see at least some declines in credit limits for credit cards. And so banks have banks start to push down credit limits for certain borrowers. And so it's definitely the case that banks were worried, probably, I think my sense from talking to Enrique is, maybe late 2008 onwards, banks started to get worried about sort of larger or more systemic concerns with their new to banking borrowers. And so, in fact, this stepping away from the study card in 2010 could in principle be in part be coming from the fact that that default rates are higher amongst this group as a whole, and that we document already in this paper. And maybe banks just in that environment were less willing to try these new forays into underserved population and moved away from them. So that I think is true for our study bank in the sense that it moved away from new borrowers, and it wasn't the case that other private banks stepped in either. And so I think your story, I think what is true is probably other banks were maybe wary of stepping in after our study bank pulled out. At the same time, I think microfinance and their Grupo Electra, which has this kind of which also does this kind of lending to underserved populations, but collateral based, that continued to grow. So that microfinance and this Grupo Electra continued to grow. So clearly there was some variation. So I think there is definitely some truth that some of this moving away from NTB borrowers, or rather, the other banks not entering here may be related to the precise timing. But it also didn't happen very much even afterwards. So we have data through 2015 in our credit card, and it doesn't seem to be a similar push towards getting in people from with credit cards that are as low as our study.
All right, thank you.
And then finally, one of the things that's going to be sort of a puzzle, if you like, if you take 1 and 2 together, which is that you have these new to banking borrowers, 20% of them default every 2 years, and it doesn't look like interest rate changes or minimum payment changes do anything to reduce default. So really, what is driving default in this population? And that's the part of the paper which I think is more speculative. We don't have a lot of convincing evidence here. I guess the 2 things that we can say are, one, it seems that if you take the correlation between default and interest rates to be sort of some evidence for moral hazard, it doesn't seem like there's much moral hazard going on in this population. We can't address adverse selection because everything is done on sort of the sample that's already selected into the card to begin with. On the other hand, we do think there is some suggestive evidence that negative income shocks play a large role in default. So for a small subset of our sample, we're able to match it to their employment history, basically everyone who works in the formal sector. And for them, we're able to trace out the link between, essentially losing your job and defaulting on debt. And there's a pretty strong link there. And so our view is that sort of it's these, what may be driving default is sort of these large idiosyncratic income shocks that hit individuals. But as we'll see, like that evidence isn't kind of super convincing. Okay, so in terms of the paper, I'll talk a little bit about the related literature, maybe go a little bit quickly through that. I'll talk a little bit about the data we have, and then I'll tell you the stylized facts are all basically sort of descriptive facts about these new to banking borrowers. I'll tell you a little bit about the experiment and how much can we plain default using things that are really not in the experiment, and then I'll conclude. Okay, so in terms of what literatures I think this paper is trying to talk to. So firstly, there's this massive literature on sort of empirical literature on asymmetric information. There's of course a much larger theoretical literature probably, but starting with Carlin and Zinman, there is this literature that kind of experimentally varies interest rates and sort of documents the effects on default and so forth. So we are contributing to that literature. I think what's a little bit different with us relative to those other papers is that we work with populations that are much more newer to formal credit than for example, the Carlin and Zinman South Africa paper, which was done with the repeat borrowers. And so I think that's a literature that we're in conversation with. There's this literature that I think in some sense we are tied to, at least in terms of motivation, although we don't really have anything to say explicitly about it, which is this entire literature on sort of suboptimal contract choice and consumer protection. So this either ranges from work by David Leibson, or which is more theoretical, or work by Charlie Sprenger and Stephen Meyer, which tries to argue essentially that there are that consumers are myopic in some sense, and that myopia sort of takes them, leads them to choose contracts that are suboptimal from the perspective, from some ex-ante perspective. So, in general, sort of making welfare statements in, time inconsistent models, for example, is kind of a fraught enterprise. So we're not really going to say very much about welfare here, but I do think that there is, certainly like a lot of the policy papers that you read. So for example, this paper by Bar Gill, policy paper written by Elizabeth Warren in the early 2000s, all of them implicitly took this view of credit card contracts, that they're sort of, shrouding their attributes, for example, and leading people to choose things that their, ex-ante self may not sign up for. And then finally, there's this literature on financial inclusion, that for the most part is mostly about just expanding things like savings accounts and credit, mostly descriptive, although there's some exceptions here. I guess what's different for our paper is we're looking at a particular product that is increasingly common in many sort of emerging country contexts, but hasn't been studied quite as much, which is credit cards. So let me tell you a little bit about the data. So we're going to use kind of 4 different sources of data. The first bit of data is the data that we have from the Credit Bureau. We have sort of 2 repeated cross sections of 1 million borrowers from the Mexican Credit Bureau. Anytime you have a loan with a formal financial intermediary, whether it's an auto loan, whether it's a house loan, whether it's a credit card loan, Compartamos, for example, also reports to the Credit Bureau. So several MFIs report to the Credit Bureau as well. You show up in the Credit Bureau, and we get a random sample of 1 million borrowers in 2010 and 2012. We can observe things like the kind of loan you have, when you got the loan, when you paid off the loan, or if you defaulted on the loan, what your credit limits were, and we have some very limited demographic information from them. The more detailed data we have is from the study bank. So that's what I'm going to call the experimental sample in the presentation. So this is data from what I'm going to call the study card. And this study card, accounted for about 14% of all first-time loans in the Credit Bureau by 2010. And this is an RCT that covered basically, it was a nationwide RCT. It covered all 32 states in Mexico. What we have is data from March 2007 to May 2009, which covers exactly the period of the experiment. And we see pretty detailed data from this. We can observe purchases, payments, fees, default, debt, and credit limit. Again, very limited demographics. And we can also match this data to the Credit Bureau data. So we can also see what's going on with these borrowers, formal loans outside of the study card in response to what's going on with the study card. So we can sort of look at, if you like, spillovers to the broader credit market. And then to look at the relationship between sort of income shocks and default, we have access to the Social Security data. This is only for workers in the formal sector, and there's approximately about 20% of our sample ends up working in the formal sector. And so we have about a match with 20% of the sample. We have individual level monthly income and employment information from them. So that'll form the basis of some of the regressions that are going to be looking at employment and default. And then finally, we have survey data from the MXFLS and the INEEC, and this is mostly going to be just trying to characterize informal credit and what the terms of informal credit look like in this market, and mostly to convince you that no matter how high the interest rates look like in the formal credit market, they're actually lower than what people pay in the informal credit market. So trying to convince you that in fact the informal credit market terms are much worse than the formal credit market terms. So this is just a quick timeline for when we have data. So the experiment starts in around 2007, March 2007. It goes through May 2009. So that's the red bar, which is the duration of the experiment. We have these, we match at 3 points in time the experimental data to the Credit Bureau data, so we can tell what's going on in the Credit Bureau with our borrowers. And then we have the Social Security data from sort of after the experiment ended. And then we also have Credit Bureau data from after the experiment ended. And this is going to be useful because we're going to be able to actually look at outcomes, up to 5 years after the end of the experiment. And that's going to actually be quite helpful when we are trying to disentangle the effects of the minimum payment on default. It'll turn out that minimum payment in particular has very different effects sort of over here relative to over here. And we'll try and explain why these differences arise.
Aprajit, there's a question in the chat.
Sure.
Has any information on financial literacy of the NTB borrowers been taken into consideration?
So the short answer is no. We actually know very little about financial literacy for these borrowers. We'll try and rule out inattention as a potential mechanism for the limited treatment effects. But Enrique actually has another paper that suggests that might actually be a concern, not just with NTB borrowers, but with credit card borrowers in Mexico in general. So he has a paper that shows that people with multiple credit cards in Mexico often have debt on many of those cards, and they, rather than paying down the debt on their most expensive card, they basically pay about the same on each card, even though they could take exactly that same payment, allocate it in a way so as to pay off their highest interest rate debt first, their most expensive debt first, and so forth. And so they don't do that. So suggesting, the point of that paper is that there's clearly some sort of friction or ignorance or not sure exactly what to call it, but people could basically reduce their debt by reallocating payments in some way, and they don't do that. So I think that may be a concern here, and certainly I think when we get to the results, maybe you can bring that up again to explain some of the null findings.
All right, thanks.
Aprajit, one question here: how do interest rates and minimum payments for this particular bank compare to other competitors in the market, other banks?
Yeah, so as I'll show you, basically the control group that we're going to have in the experiment is going to have terms that are broadly comparable to the rest of the market. And it's actually going to be quite different from the terms in the treatment arm. So when we get to the description, I will tell you exactly what's going on. But basically, in the treatment arms, the interest rates are typically lower than the market interest rate, and the minimum payments are going to be typically higher than the market minimum payment. Does that answer your question?
Yeah, it does. Yeah.
Okay. So what I'm going to do is I'm going to kind of proceed in two steps. So first, I'm just going to give you some stylized facts about the market. I'm going to try to convince you that financial inclusion is sort of a risky proposition and that screening ex ante is difficult. All of this is kind of going to be done with observational data. And this is the part, when we send it to referees, this is the part the referees find least convincing because it's sort of observational data. On the other hand, I mean, I do think this is an important part of the puzzle. It's just that we haven't maybe shown it, to the satisfaction of the referees. The second part are the experimental results. So in that sense, they're much cleaner. We're going to show you that risk is pretty hard to mitigate with contract terms. And suggesting that in fact moral hazard doesn't seem to be a first order concern, at least with this particular card and with the range of interest rates that we experiment with. So what I'm going to do is now tell you a little bit about the study card itself, and then tell you a little bit about the sample. So this is a store card. So in other words, this is a card that can only be used at a certain set of stores. And these stores account for about 16% of total household expenditures, based on kind of scanner data that Marco Gonzalez Navarro put together for us. And it accounts for about 44% of total supermarket expenditure. So so even though it's a store card, it's used at actually a bunch of stores and restaurants that account for a significant chunk of total household expenditures. It had about 1.3 million clients by 2009, and about 15%, I think 14.4% or something like that, of all first-time formal sector loan products came from this card itself. So in our view, this is kind of a big part of the financial inclusion or serving underserved population story, just this single study card itself. So there's sort of here you can see the other ways in which people enter the credit bureau. So other than credit card, there's some sort of personal loans that people take out, a credit line, real estate loans, and auto loans are sort of the other big contributors to entering the formal credit market. So here's the sample frame. So who was included in the study? So the sample frame consisted of cardholders who had paid at least their minimum payment for the past 6 months up till January 2007, which is just before the experiment started. This gave the bank about 1 million borrowers. So one thing I guess to note here is that this is, if anything, a sample that's already positively selected. So these are people who in each of the past 6 months prior to the start of the experiment had paid exactly their minimum payment, had paid at least their minimum payment. So if anything, this is a positively selected sample. And from this sampling frame, the bank drew a stratified random sample of 162,000 card holders. I'll explain the strata in a little bit. For about 57% of these card holders, this was the first credit card they ever had. And for a little less than half of them, this was the first ever formal sector credit product they had. So that's the sense in which we think of ourselves as really working with a population that is really new to credit. So what the bank did was they took the sampling frame of a million individuals and it partitioned them into 9 different strata based on 2 variables that were kind of used internally within the bank as well to kind of flag borrowers. So the first is sort of how long you've been with the bank as of January 2007, and this was divided into 3 classes. So if you've been with the bank sort of between 6 months and a year, between 1 and 2 years, and between and greater than 2 years. So in fact, it turns out that most people have been with the banks between 1 and 2 years. And then the second stratifying variable was the repayment history. So you were classified as one of possible 3 repayers. So the full payers is the easiest to describe. These are the people who, in the year before the experiment began, paid their bill every month in full. And basically incurred no debt. So in the paper, we discussed these treatment effects for this group in more detail, but basically these are people for whom the treatments had absolutely no effect whatsoever, and maybe not surprisingly, right? For them, they always repay their debt even before the experiment started. So manipulating the interest rate or the minimum payment doesn't cause them to change their behavior. The minimum payers are people who have paid on average less than 1.5 times the average of their minimum payment in the year before the experiment. So you can think of these as kind of the worst payers in the population. And in fact, this is the largest of the 3 categories in this partition. And so, putting these 2 variables together, you get 9 strata, right? 3 different cells in each variable. And the bank sampled 18,000 borrowers from each stratum. And I think what we do for the regressions is we use the strata weights in order to make population statements, and that's just because the strata are very different sizes. So if you use unweighted regressions, you basically tend to upweight, for example, the full payers and the 24 months plus strata, which in fact is quite small in the population. And so for that reason, we're going to use stratum weights whenever we use the regression, just to be able to make kind of population statements. Sometimes we'll just look at treatment effects for particular strata. So in particular, sometimes we'll just look for treatment effects amongst the people who've been with the bank for, say, the shortest amount of time. And there, of course, we won't do any weighting. So what was the experiment itself? So it varied both interest rates and minimum payments for 144,000 card holders. 18,000 of them were in the control group, and the treatments itself was a full block design of 4 possible interest rate levels and 2 possible minimum payment levels. So that gives us 8 possible treatment arms along with a control arm. So we'll have 9 different intervention arms. So let me tell you a little bit about what the summary statistics look like for this sample. And I guess one way to try and benchmark this is to benchmark this sample against the average member of the credit bureau, and that's the average sort of credit bureau member. So on average, people were much poorer than the average credit bureau member. So income was about, monthly income was about 14,000 pesos versus about 23,000 pesos. Their credit scores were actually quite low. They were about 645. Typically, credit scores less than 700 are ineligible for any kind of reasonable credit card product during this period. Their credit limit was much lower than the average credit limit in the credit bureau, so about 8,000 pesos relative to 18,000 pesos. And so overall, we think of this population as being relatively poorer compared to the average sort of member of the credit bureau. Okay, so the other thing I want to introduce before we start talking about the stylized facts and the experiment is this measure of bank revenue. So this is something where we had to sort of do a lot of rule of thumb kind of judgments. So in principle, if we observed a credit card right from the time it was born to the time it was canceled or defaulted on, we could just take the payments minus the purchases and compute the present discounted value of that stream of payments and purchases, and that would give us some rough measure of the revenue generated by that card for the bank. Now the problem is, of course, for our data set, we only observe the payments and the purchases during the 26-month window for which we have the experiment. And so we kind of need to make some assumptions about how the card is going to behave sort of before the study period and after the study period in order to construct some measure of revenue from the card. And so what we do is we basically assume, so what we do is we subtract off the debt at the start of the study period in our measure of bank revenues, and then the debt that you have left over at the end of the experiment, we assume that you make no more purchases after the end of the experiment, and with a certain probability you default. And if you default, the bank recovers 10% of the default amount, which is seems to be kind of the figure that banks themselves put in their balance sheets when they sell this debt essentially to collection agencies. So these are pretty strong assumptions, and I don't want to defend them particularly as being an accurate measure of bank profit. Certainly, we're leaving out a lot of other expenses, so expenses on promotion, for example, merchant fees, for example. But we do think that this is a useful measure. So on the left-hand side, we have the net present value, just a histogram of this at the card level. So the net present value is about 4,000 pesos. So think about the bank making about 4,000 pesos per card. It's the dispersion is about twice as large as the mean. And I guess the part that makes us think that this is perhaps somewhat meaningful is that when we look at the relationship between this measure of bank revenue and credit scores, that relationship actually looks quite similar to graphs that people have drawn for the United States using kind of better data than ours. So Sumit Agarwal and co-authors draw a graph very much like this in the US, and it has this sort of inverted U shape, which basically also matches conventional wisdom if you talk to people who work in the credit card industry, which is that sort of people at the very end of people at sort of both extreme ends of their credit scores aren't really making a lot of money for the banks, but perhaps for different reasons, right? So people at the very top end are essentially people who are repaying their bill in full every month, so the bank's not making any money really off them, other than perhaps through merchant fees and so forth. And people at the lower end of the credit score are often likely to default. That's built into our measure of revenue here. So we think that this kind of this picture gives us some reason to believe that what we are constructing is not completely noise. And then, as we'll see, I think even the treatment effects are kind of consistent with this being a somewhat meaningful measure of revenue. Okay. So now I want to talk a little bit about just kind of brief descriptive facts about this new to banking borrowers in Mexico. So in general, the decade of the 2000s was one where large banks reached out to previously underserved populations and typically reached out using a store credit card such as the one that we're studying. And the particular study card that we used played kind of a significant role in its growth, as we pointed out earlier. Where did this come from? So in part, if you read interviews by former CEOs of different banks, it seems like it was at least in part inspired by the experience of MFIs like Compartamos, as well as the lending branch of Banco of Azteca, which is actually a Grupo Azteca, which is actually a group of department stores. And what they started to do was they essentially started to give people loans on the basis of goods that people bought in the stores themselves. So you buy a fridge from Grupo Azteca, and then you get a loan, which is sort of the collateral for that loan is the fridge itself. And Compartamos, of course, is kind of an MFI that's been well studied. Dean Carlin and co-authors have several papers, in fact, on Compartamos. So both of these outfits, though, operate in a very different way from Bank A. Bank A is more or less a traditional bank, whereas Compartamos is an MFI. It used to require, and typically does in some of it, still requires some kind of joint liability. Grupo Azteca requires some kind of collateral, right? Our bank is offering credit cards, which is non-collateralized credit. And perhaps most significantly, both Grupo Azteca and Compartamos spend considerable resources on face-to-face interactions and home visits. So these are situations where they're really, overcoming the asymmetric information between themselves and the borrowers. And this is not something that Bank A is doing. Bank A is adopting, I guess, what people in the credit card literature call kind of the distance lending method, which is, you sort of try to use, there's sort of relatively limited interaction with borrowers, but you try to use data and other approaches to try and limit default. So here's the first stylized fact, and this is really trying to convince you that borrowers are credit constrained. So this is a population that has a demand for credit. So it's fairly, it's not always straightforward to demonstrate the existence of credit constraints. And what we do here is we just take an off-the-shelf measure that was used in this paper by Gross and Souleles, which is basically looking at the correlation between debt and limit and debt limits to get at a measure of credit constraints. And the intuition is that if borrowers increase their debt when their credit limit changes, that provides, at least under some assumptions, some evidence for the presence of credit constraints. Of course, limit changes to your credit card are typically not exogenous, and so what Gross and Souleles and what we do is to sort of use timing rules as an instrument for these changes in limits. And what we mean by that is essentially, if you've had a limit and the bank is not going to, if you had a limit in, say, January, the bank typically doesn't consider you for a limit, for another year or at least. And so you can sort of use time since the last limit increase or limit change as an instrument for a limit change, or how long it's been since the last limit change. And again, this is something that I think is potentially problematic. I think that the only real point we wanted to make here is that the numbers that we get from these regressions are much higher than the numbers that you get from similar regressions done in the United States, and that is consistent with with sort of our population as being credit constrained. In addition to being credit constrained, they also appear to be liquidity constrained to the extent that 80% of the borrowers paid less than 1.5 times their minimum payments on average before the start of the experiment. So kind of the big takeaway from this part, hopefully, is that these borrowers are credit constrained, perhaps also liquidity constrained. The second stylized fact that we want to establish is that default rates are pretty high in this population. So during the 26-month study, about 20% of the control group defaulted on the study card, and then comparable number for the overall default rate in the credit bureau was about 12%. So the rates are higher in our population. And in fact, it's even higher if you look at the subsample in our study of people who've been with the bank for the shortest amount of time. So the default rate is almost 36% for them. And it's about half of that for borrowers who've been with the bank for more than 2 years at the start of the experiment. It's only about 18% of them. So this tells us that sort of default rates are high, and in fact, they're higher for newer borrowers relative to older borrowers. So that's, and the other thing that this graph draws, we also plot revenue, and we see that in fact the bank is making lower levels of revenue from people who've been with the bank for a relatively short period of time before the start of the experiment, relative to people who've been with the bank for a longer period of time before the start of the experiment. So that's sort of trying to explain this figure here. This figure here is just trying to make the point that in our study card, the default rates are just much higher than the default rates for either people with credit cards from the same bank, but other credit cards, not these credit cards that are targeted towards lower credit score individuals, or if you just look at credit cards issued by other banks. So that's sort of the level difference. And the other is that these default rates are declining in how long it's been since your card was opened as of January 2007. So if in January 2007 you had a card that had been open for, say, 31 months or so, then in subsequent 26 months, your default rates were much lower than if your credit card had only been open for 6 months before the start of the experiment.
Brian, just one clarificatory question.
Yep.
So this 24 plus, the people who have been there with the bank for very long, longer, this is typically a selected sample, right? So these are probably people over time that have not defaulted, and therefore probably are people who have, who yield higher revenue. Is that?
Who are, sorry?
I mean, I'm just wondering whether these 24 plus is the fact that you have a longer period is a function of the fact that your previous performance has been better, and that's where you get loans and so on and so forth. So the chance of default is lower. Is that a right way to look at it, or am I just missing something?
So I think you're definitely correct in that think of the 24 plus as being a selected sample from the 6th to 11th month plus. So like going from here to here, there's going to be a lot of selection. A lot of people are going to default between here to here. So that is definitely true. At the same time, if you look at people who've been with the bank for 2 years or more, a majority of them are actually people who are not full payers. Actually, majority of them are people who are minimum payers. So people whose payment behavior is actually, the worst, quote unquote, of the three categories. And so that's in fact part of the reason why the bank is making a lot of revenue off them. So these are essentially people who are, incurring a lot of debt, and that debt is, incurring interest at a high rate, and they're only paying down a small portion of that debt each month because they're only repaying, 5% of the debt or 4% of their debt as opposed to the entire amount outstanding.
I see. So it's a selection on revenue. So essentially one way to think about it is these are people who are continuing. Maybe the bank is encouraging them because it's going to earn a lot of revenue.
Exactly. In fact, I have a friend who works in the credit card industry, and his view is that basically these are the kind of people the bank loves. So these are people who basically make at least their minimum payment every month, right? So they're not technically delinquent, and so the bank doesn't have to report them as being delinquent and so forth. And they stay around for a long time, right? And so so these are, I guess what I'm trying to say is these are not necessarily positively selected from the point of view of like repaying their bill in full each time or something like that. That's a very small fraction of them. Yeah. Okay. So the third stylized fact that we wanted to establish was that these are new to banking borrowers, and for them, predicting either default or revenue is difficult. And so we do this basically by running a whole set of regressions, simple linear regressions, but also kind of fancy machine learning methods that Diego kind of did, and I don't really know how these work, except that they're what we do is not particularly well done in terms of being able to predict these things highly. And so the big takeaway here is that we don't seem to be able to do a good job in predicting either revenue or default. I've only shown you the results for revenue here. There are a couple of big caveats here. One is that in some sense, these out of sample fits are an overestimate because we're only running them on a sample that's already positively selected. These are all people who, were admitted to the bank, were given the credit card, and then we run a bunch of, predictions based on the data we have from them. In some cases, we in fact have more data than what the bank would have at the time of application. Sorry, is there a question?
I think that's just white noise.
Oh, okay. All right. Okay. And so I think that, so in that sense, I think that if anything, you can think of this as maybe an overestimate of how well we do at prediction. And so, but, that's okay for us because I think the only point we wanted to make here was that it's hard to predict default and revenue for these new to banking borrowers. And that's really just going to provide motivation for why we think we should, even manipulate, say, interest rates and payments, because if you don't do a good job screening, maybe you can do something ex post. So that's sort of fact number 3. Fact number 4 is the one that I think actually, if someone can write a nice paper on this, I think this by itself would be a super interesting paper. So I wonder if it's possible to do that. And this goes back to an idea that that Joe Stiglitz wrote about in '94. Although I think apparently this idea has been around in some version even before that. And this is the idea that there's actually a first lender externality. So the first time a lender decides to lend to a borrower who has no credit history, and that credit history is made public by providing it to a credit bureau, for example, that first lender sort of generates an externality to subsequent lenders, right, who can then condition their own lending decision on the outcome from the borrower's first loan that was given to him by the first lender. So what Stiglitz argues that, in fact, because of the fact that the subsequent lenders use these histories generated by the first lender to screen borrowers, that generates an externality. And since this externality is not accounted for by the initial lender when they make their lending decision, you in fact get sort of lower levels of financial inclusion than you might expect, relative to a situation where this externality is actually, accounted for in some fashion. So that argument, I think, has been around for a while. there's actually no empirical evidence that tries to quantify any of these things in that argument. And so that's what we wanted to do with this data. And the sort of standard comment we get from referees is like, "Oh, this is a super interesting question. If you can answer this convincingly, then the paper actually can stand just on the basis of that result." Unfortunately, what we have here is purely observational data. We don't use any of the experimental variation to get at this, and we don't, in fact, so it's a little bit hard to say that we are really nailing down even the sort of basic numbers with respect to this externality. So this is just, I think, an advertisement for people who, if you can find a way in which you can do this convincingly, I think it's a very nice paper to be written. So here's what we do, and then I guess we can think about what might be a way to do this with using more convincing variation. So what we have on the x-axis here is the change in the credit score from June 2007 to June 2008. So for the first year of the experiment, we look at what the changes in credit score were for borrowers, right? So this is of course endogenous, and that's part of the problem with the regressions that are trying to do this. And on the y-axis is we have the fraction of closed accounts that were closed in the year after this. So in the year from June 2008 to May 2009, so for the remaining part of the experiment. So we basically look at what happened to your credit score in the first year of the experiment, and then what did you do in the second year of the experiment with respect to closing your accounts, for example. And so what we see here is that part of the story is certainly true. We see that people who had significant increases in their credit score, so people whose credit scores, say, went up by 40 or 50 points, they were much more likely to close their account with the bank. That's sort of this point here, than people who had reductions or really even no changes in their credit score. So the positive slope is consistent with the argument that basically people, outside borrowers are conditioning their lending on the behavior of these borrowers within the bank in the first year. And then this is looking at what people do outside the bank or outside of the study card. So this x-axis remains the same. The y-axis is now the fraction of borrowers at each level of the credit card change, credit score change, that get a loan in the year after the change in the credit scores. And this is done separately for the same bank and the other banks, because you think that in fact the bank might try to internalize this by offering
diagram showing price of Turkey and the producer surplus at the price, explaining what this producer surplus measure.
Sorry, I didn't.
Surplus measure. Market efficiency, consumer surplus, and producer surplus are past tools that economists use to study the welfare of buyers and sellers in the market. These tools can help us address the economic question.
I'm sorry, I did not understand that.
Is the allocation of resources determined by the free market desirable that we know social product?
Is that a question or someone else's?
We introduce into our analysis a new.
That's not a question. I mean, that's nice.
Oh, that's not a question. I'm glad that's not a question. I was just like, I really cannot follow. Okay, so should I just continue then?
Yeah. I think
okay.
Someone's thinking.
So this is the second part, which tries to show that borrowers with positive changes to their credit score history are more likely to get loans or formal credit products, both from Bank A, from our bank, as well as from other banks. So I think the biggest bit of pushback we got, as you might imagine, is that this variable is clearly endogenous, right? The set of people who show improvements in their credit scores, are presumably doing things that might be correlated with things that also are more likely to get them credit from other banks or leave the current bank. So I think that's clearly the problem here. And our experiment itself, unfortunately, did not generate any exogenous changes in the credit scores. So, changing people's interest rates or changing their minimum payments, didn't really affect defaults. And since it didn't really affect defaults, it didn't really change people's credit scores itself. And so I think that's part of the problem here. But I really, so I think if people are looking for ideas to take and work on, I think this would be like a paper on this a convincing paper on this, if you can sort of show truly exogenous variation in credit scores or some measure of credit worthiness for people who've just entered the formal credit sector, and seeing what happens to their subsequent borrowing, but from other lenders, I think that would be, really interesting. And I think, you could probably get a nice publication out of it. Anyway, this is the one that we get the most pushback on, but I just leave it out there as suggestive evidence.
Prajit, one question regarding the predictability. So,
Yeah.
I mean, I'm sure you address this in your paper, but I mean, these are a couple of algorithms, and is it possible that there might be some other ML algorithm or something else, or changing some hyperparameters that lead to improvement in this out of sample validation R square?
So the short answer is we tried a whole bunch of them, and we're just presenting the random forest because it did the best of the ones that we tried. So that's, I think, one answer. So it's not that we just tried the random forest. We tried, like Diego tried, a whole bunch of them. And I think the paper has a list of the various ones he tried. I think that where we were able to do something is, I think if you look at default, I think we did do a better job of predicting default than revenue in some cases. And there, I think, I don't know if it was the random forest that performed the best or not, but certainly I think that. So I think the big problem, though, regardless of the algorithm you use, is just the fact that you have relatively limited data. So it's not like we have tons of features that we can use to train the algorithm to begin with. These are new to banking borrowers. If you think about people, for half the sample, this was their first formal sector loan product to begin with for them. So for them, by definition, we basically have no formal credit history at all. And so just maybe using machine learning is actually a bad idea here. I mean, it's bad in the sense that you typically think it works well when there's like large K, or K is the same order as N or something like that. And here, the number of features are pretty small. And I think that's maybe the other issue.
So I'm wondering that in context of the algorithm that the bank uses. So, I mean, do you have any sense of what algorithm does the bank use, in the sense, because ultimately you want to not point at that how hard is the problem, but how hard do banks find to predict that?
Yeah. So our sense is that at the time the study card was being issued, the banks did not use any particularly fancy algorithm. They tended to classify borrowers using those two stratifying variables that we talked about. And they sort of looked at default in those 9 bins. And that, in fact, was the reason why the stratification was done using those 2 variables, because internally, sort of that's how the bank used to bin their borrowers. Now, I'm not sure. So, 10 years on, what the bank is doing, it's not totally clear to me. I think there is definitely a lot of work being done on thinking about how one could use other kinds of data to predict repayment behavior with respect to borrowers who are new to the financial sector. So Dan Bjorkengren has a nice paper, and Josh Blumenstock also has a nice paper where they basically look at, can you predict loan repayment behavior using basically all the data that you can suck up of people's mobile phones or social media or other kinds of data. And they find that actually, in some cases, that kind of data does no worse at predicting default than like credit scores do. And so this is for a country that's kind of unnamed in the paper, because I think they got hold of sensitive data. And so I think that's all to say, I think banks nowadays are probably doing much better than what they were doing about 10 years ago. So I think nowadays, certainly, you would probably get better algorithms, or you maybe be collecting better information or more information, especially like Dan argues that you should be just using a lot of this other information to do predictions. I think the problem with some of that work is that, once people know that their media, that their sort of data footprint is being used as a measure of creditworthiness, people may start gaming that system as well. And so I think Josh Blumenstock has some work that tries to say, how would you design a repayment system, taking into account that people know that you're going to use their, Twitter post to predict default or something like that. So I don't know if that quite answers your question.
Yeah, that's convincing. I was just interested in how hard it is to predict, like what information do banks have, and I think, yeah, that's convincing.
Okay.
Aprajit, we have about 20 minutes left. So.
Oh, okay. So let me then go to the experiment itself. so I can spend a little bit of time on the experiment. So this is the experiment itself is trying to answer, whether can we change default behavior with manipulations of the interest rate and the minimum payment. So there are 4 different levels of the interest rate. This is an annual level interest rate that was set between 15, 25, 35, and 45%. And the minimum payment was set to be either 5% or 2%. And so we get 8 different treatment arms, and we have 9 different strata. And so we have 2,000 individuals allocated to each of 8 interventions arms within each strata, and then we have 1 control arm. And so someone asked, how do we think about market terms? So the market terms are roughly about 55% for the interest rate and about 4% for the minimum payment. And this is what was, in fact, roughly speaking, the conditions in the control group. Unfortunately, the problem is there was some variation in the interest rates in the control group, and that variation has not been recorded in our data set. And so we don't exactly know how much the interest rate, for example, is being paid by a particular card in our control group. And so for that reason, we're not going to use the control group when we show you the average treatment effects. What we're going to show you is I'm going to compare the group that looks the closest to the control group. So this is the group that had an annual interest rate of 45% and a minimum payment of 5%. So we're going to compare this to the different treatment groups. And again, for the talk itself, I'm just going to look at 2 possible treatment groups of the 8. So I'm going to compare a 45% interest rate to a 15% interest rate amongst people who are paying 5% minimum payment. And then I'm going to compare a 5% minimum payment to a 10% minimum payment amongst people who are paying 45% as their annual interest rate. So there are, of course, other contrasts, and the paper carries out these other contrasts. And some of them I think are interesting in telling us what might be important, and I think are interested in, are kind of maybe suggestive about the importance of liquidity constraints. But for the paper itself, I'm mostly, for the slides itself, I'm just going to focus on these 2 contrasts. Okay, so this was an experiment that was carried out by the bank. Basically, you can tell sort of it was done unilaterally with these 2 points here. Borrowers were just informed about their new contract terms in the 2007 statement. They weren't given any other information. They weren't informed that they were part of an RCT. They weren't informed about when these terms would end. Similarly, at the end of the 26 months, there was no pre-assigned, pre-announced end to the trial. They just received a letter at the end of May 2009 that told them that they had been moved back to the sort of pre-intervention minimum payment and interest rates. So in that sense, there was no, there was no informed consent. There was no, there was no anticipation or pre-announcement of the end of the experiment either. So the main outcomes that I want to talk about are going to be default. It takes on the value of 1 if the borrower hasn't paid the minimum payment for 3 consecutive billings. So this is clearly important for policymakers, important for banks as well, since it directly affects profits. And in this literature on asymmetric information and credit markets, usually a correlation between default and interest rates is seen as sort of a reduced form test for moral hazard. The other outcome that I think is interesting to look at is cancellation. So this is the situations where a borrower repays the debt and closes the study card. And this actually, I think, is useful because it provides us some revealed preference evidence on the effect of the contract term changes on the relative attractiveness of the card, right? So this is a very active decision taken by a borrower. They pay down their debt and they cancel the card. And so we think of that as being pretty good revealed form evidence about whether they find the card attractive or not relative to the other cards in the market. And we'll see the minimum payment intervention does really affect cancellations. And then finally, we're going to look at the effect of these interest rate and minimum payment variations on revenue, just because we want to be able to say something about, what is the effect of changing these contract terms on bank revenues and, broadly speaking, bank profitability. In terms of
this voluntary client cancellation, but if you don't have any evidence that they actually choose other cards, right? This could also be your kind of attitude towards taking debt, that you've taken it didn't work out for you, so you just pay whatever you have to and just shut this kind of borrowing vehicle.
So we do have evidence. So we can look in the credit bureau data to see if they do open a card with another bank. At least so we can see, at least within the formal sector, if they take out another loan. It turns out that they actually don't do that. So we don't see much of that at least in the longer term data. But you're right. I mean, if people are, for example, substituting to informal credit, then we definitely don't see that. That's definitely true. Yeah. So that's one big caveat here. Everything's
on credit cards that happens, right? I mean, I'm talking at a different level, but often one takes credit cards with certain deals, then one tries for some time, and then it's not very useful. They feel that they may have spent more than they should have. They just pay back what they had to, and then just exit that kind of an instrument.
Yeah, so we definitely see that in, for example, when I'm going to show you, comparing these two arms, you definitely see some cancellations in this arm as well. It's just that you see more cancellations in this arm. Okay, so you're absolutely right that people are canceling for other reasons, for sure. That's right. Okay. And so even though we have monthly data, what I want to show you is I'm just going to show you results, two sets of results. One set of results, I'm just going to show you results at the end of the experiment in May 2009. And then I'll show you really long-term results in 2012, kind of 5 years after the start of the experiment. So the big headline figure here is that when about 20% of what we're calling the control group, which is that 45-5 arm, defaulted during the course of this experiment. What happens when you reduce interest rates to about a third of what they used to be? So that is from 45% to 15%. You see that default only goes down by about 2.5 percentage points over the 2 years or so of the experiments. So this gives us an elasticity of about 0.2. And this elasticity is in fact much lower for newer borrowers than it is for older borrowers. So newer borrowers are just much less responsive. And to the extent that you think that you're much more worried about asymmetric information concerns with newer borrowers, they also end up being even less sensitive to these kinds of changes. If you look at what happens what happens to the interest rate, what happens to the average treatment effect when you look at the minimum payment of 10% arm. So, if you compare 45 versus 15 amongst the two groups that are both paying a 10% minimum payment, then in fact there's no effect on defaults at all. And the elasticity is statistically, is smaller in point estimate terms and is not statistically significant at all. And so these figures tell us that, to the extent that you think that a correlation between interest rate and default is some evidence of moral hazard, then at least by that metric, moral hazard doesn't seem to be an important issue here, at least for the range of interest rates that we consider here. So that's as far as interest rates is concerned. And I guess I don't have time to maybe go through the literature in detail, but this number of 0.2 is considerably smaller than what most of the other literature has found by experimentally varying interest rates. And we can come back to the reasons for why that might be towards the end of the talk. Now, what happens with the increases in minimum payments? And so we see, in fact, that the increases in minimum payments had an even smaller effect. So it's about 0.5 percentage point increase in default. And in fact, the elasticity is about 0.02. So, even doubling the minimum payment from 5% to 10% had almost no effects on default. And this, ex post might be a little surprising, because if you look at the baseline data, almost 3/4 of borrowers paid less than 10% of the amount due before the experiment started. But once you actually made the minimum payment exactly 10%, you saw very few people defaulting. So that's sort of the big result is neither the interest rate decrease nor the increase in minimum payments led to any significant changes in default rates. So in the interest of time, let me skip this slide, which just kind of carries out comparisons with other papers in the literature. And instead, let me talk a little bit about cancellations. So here we actually see much more action. So for example, if you lower the interest rate from 45% to 15%, that reduces cancellations by about 3.5 percentage points. And the implied elasticity is almost twice of what it was for default. So you definitely see people being much less likely to cancel when they get a lower interest rate. And maybe that's not so surprising to the extent that these interest rates are now attractive relative to what's going on in the market. And so for sure, I think what this rules out is sort of inattention as a potential cause for the limited effects on default. So you might say, well, there's not much of an effect of default because people are just not observing their contract terms. They just look at their bill and they throw it away. I think this evidence on cancellation suggests that inattention is really not that relevant an explanation, because we see here people are responding to changes in the contract terms, at least as far as cancellations are concerned. Similarly, when you double the minimum payment from 5% to 10%, you increase cancellations by about 1.8 percentage points. And so clearly you see here again, people are moving away from the higher minimum payment card because it's presumably less attractive than the 4% minimum payment, which seems to be sort of the market standard during this time. Okay. So in terms of revenues, I guess this is maybe not so surprising to learn that banks are maximizing profits, in the sense that we see that any departure from the 45-5 arm reduces bank revenues, right? So this is consistent with the idea that the bank is maximizing profits, right? It's setting interest rates and minimum payments in such a way to maximize profits. Changing from either that minimum payment or the interest rate is going to lead to a decrease in revenue. And so this tells us that the revenues themselves are being set optimally. It's not so surprising maybe, but also tells you why banks are charging interest rates and minimum payments at the levels that they are. So finally, I guess this is maybe just a little bit of the completion of the story. We see that at the end of 2009, the bank actually stopped issuing this credit card. It moved away from these new to banking borrowers, and it doesn't appear that other bankers stepped in. So in fact, by 2013, if you look at the credit bureau, the number of loans that are going to clients with very limited credit histories or clients who are just coming in has come down by about 60% relative to the number in 2006. So this tells us that, to some extent, at least even in 2013, there was relatively less of an effort by these large established banks to go after new to banking borrowers. So this was a question I think someone asked, which is, do you know what's going on with other banks as far as our borrowers' behavior is concerned? So you might imagine that either a lower interest rate, or as other people have suggested, like a higher minimum payment, might lead borrowers to look elsewhere for more attractive terms, right? And we find actually no effects on these. So whether we look at defaults at other banks, whether we look at cancellations at other banks or new loans at other banks, we see no treatment effects. So we don't really see, at least as a result of these interventions, people being more likely or less likely to get loans from other institutions. So we see not much evidence of spillovers. There is some evidence. So Dean Carlin and John Zimmerman have a paper where they try to look for these spillovers for microfinance clients and don't find substantial evidence of that either. So I think our evidence here is kind of consistent with that literature. So the last part, I guess in the last few minutes that I have, I want to talk a little bit about the long-term effects. And I think this is a little bit interesting because I think it allows us to dig a little bit deeper into the zero effect for the minimum payment. So let me focus on that for now. So what we see first is that when we look at what default looked like in 2012, which is 3 years after the end of the experiment, and you compare the treatment arm that had an interest rate that had a minimum payment of 10% to a minimum payment of 5%, you see that the default rate is about 4.3 percentage points lower than the default rate for people in the quote unquote control arm. And so this effect is much larger, both substantively and is also statistically significant relative to the pretty small and statistically insignificant number we saw at the end of the experiment. And so this, in fact, I think gives us some intuition for what may be going on here. And this is the part that I guess we're trying to work on a little bit more. And I just realized I didn't put in the slide for that. So you can imagine you can imagine two things that happen with an increase in minimum payments. And this is something that's been noted actually even in the policy literature on increasing minimum payments. And that is that increasing the minimum payment is going to, first and foremost, it's going to increase your short-run liquidity constraints. So right, instead of only having to pay 5% of your outstanding amount, you now have to pay 10% of your outstanding amount. So you're going to have to do more work to find that 10% than you would to have to find that 5%. So it's going to tighten short-run liquidity constraints. And that those tightening short-term liquidity constraints might cause more default if you're not able to put together that money to cover the 10%, right? On the other hand, paying down 10% of your debt outstanding is going to decrease your overall debt. And so to the extent that that the debt repayment burden has an effect on default, it's going to mechanically lead to a decrease in default, just because you have less debt to repay, and that less debt is going to be easier to repay because you have to repay less whenever you need to repay your debt. So you can think of these as two kind of countervailing effects that were both operational during the experiment, right? You had a short-term liquidity constraint that was tightened, but at the same time, your overall debt was coming down, and these sort of worked against each other. And so, one way of telling the story is to say that these worked against each other and then canceled each other out during the course of the experiment. But now you can ask what happens after the experiment. So after the experiment ends, the short-run liquidity constraints are no longer present, right? That's no longer tight because you go back to a 4% minimum payment. So you go back to there's no tightening of short-run liquidity constraints, and your debt is already lower now, because if you're in the 10% minimum payment arm for 2 years, that means your debt at the end of 2 years is lower than the debt for people who were only in the 5% minimum payment arm, right? And so at the end of the experiment,
just one clarification. So this includes the people who voluntarily shut down their cards. So it's an average over that, or is it conditional on continuing?
So we can do it both ways. What I'm presenting here is ITT. So I'm basically doing it. I'm including people who've shut down their cards, but even if we exclude the people who shut down their cards, you still get the same effect.
I see.
Does that make sense?
Yeah.
I'm not sure what's the cleaner way to do it. I guess we thought doing the ITT was cleaner because we then just keep everyone, and then maybe the interpretation is a little harder, but we could also do it with cancellation. The problem is once you do it with cancellation, you end up with a selected sample, and then you have to sort of think about that sample selection affects you in some way.
No, I think the ITT is right. I just that one may want to know where that number is driven by, who the number is driven by, right? Is it driven by the fact that that's all? I mean, it's not to. I mean, you still should have the ITT, but just that whether it's just the fact that some of these guys are not there and so they're recorded as zero default, or is it the fact that the people who remain have less default? Just to clarify that, that's fine.
Yeah, that's a good question. I mean, that's a good point. I think we can present both of those together, right? So that's a good point. And so I guess our interpretation right now is that this 0.043, the fact that default is definitely lower in the 10% minimum arm, at a 5-year horizon, reflects the fact that the sort of debt repayment burden does matter. And when you exogenously decrease debt for these people who were exogenously assigned to the 10% minimum payment arm, for them defaults are indeed lower. But that if you were looking just during the course of the experiment, the fact that you had these tightened liquidity constraints, that you had to pay 10% instead of 5%, ended up causing more people to default during the experiment, or ended up sort of those two forces sort of counteracted each other during the experiment. So that's sort of I think mainly that's the last point I wanted to make sure I conveyed. This thing, I guess I don't have too much time to go through, but I think one of the mysteries behind this paper ended up being I started this paper by telling you that these NTB borrowers have very high default rates. And then I told you that, even if we do these large experimental changes in contract terms, they don't really have much of an effect on default. And so one sort of natural puzzle is, okay, then what explains these default rates? Like why is 20% of the sample defaulting every 2 years or so? And so I guess that's the part that we're struggling with the most. And again, that's I think also least convincing because we don't have strong sort of evidence on that front. So I guess there are 2 points that I want to make here. First, liquidity constraints themselves seem to be important to the extent that we see this differential long-term effect between short and long-term effects for the minimum payment. So that tells us that liquidity constraints may be an important factor for this population. And then the second thing, which I haven't shown you results for, it's in the paper, is that we basically, again, sort of borrow a strategy from the sort of US labor literature, looking at what happens when people get laid off as part of kind of a mass layoff, and what happens to their default. And we see, in fact, that there's a very strong correlation between being laid off and defaulting on a formal sector loan. And we do this in a situation where we control for individual fixed effects. And so, that's sort of where we leave things as far as the paper is concerned. But again, this is sort of, maybe 20 years ago, you could have published a paper with that sort of individual fixed effects kind of strategy. Here, we get a lot of pushback from referees basically saying that, this is interesting, but, it's individual fixed effects. You don't really have any exogenous source of variation. And so at most, this is kind of suggestive. And so that's sort of where we are with this paper. Kind of the cleanest results are the RCT results, which are unfortunately mostly, pretty small. And then the other stuff we have is actually quite interesting, but is I think only suggestive. And so we're kind of at this moment struggling with how to kind of put these together in a way that's going to sort of be more appealing to referees. So yeah, I think that's mostly all I wanted to say. I think I said most of everything on this slide here. Okay, thank you very much, and I'm happy to. I think Arup said people may want to talk, so I'm happy to stick around for questions or just to chat or something for a while.
Aprajit, I can have a chat with you, but I don't know about others. There's actually I learned a couple of other conferences going on right now, and many of them are there. So they wrote to me saying, "Oh, this was a bad timing." Is it? We can chat, but is it possible sometime next week if I can set that up with you, where there are other people who may be interested who can talk?
Sure, absolutely. I'll be happy to talk. Yeah, I'm not teaching this semester, so I'm happy to talk anytime.
Okay. Let me just quickly ask Sugat, Kanika, since at least they look to be here.
Yeah, we're here.
Yeah, I'm here.
Yeah. Kanika, would you like to? I can talk to Aprajit later. Do you want to have a chat with Aprajit after the seminar is over? I mean, Ganesh will, of course, announce the seminar close at some point, and then.
Yeah, I'm happy to do so. Yeah.
Okay. So, and anyone else also, Ganesh. So you follow your protocol. Maybe Ganesh thought I should be having the protocol anyway.
All right. So thanks, Aprajit, for a very interesting talk. I think we're kind of out of time. So thanks for the participants too showing up. And yeah, so we'll end the talk right now.
Okay, thank you. So